Imagine investing stress-free, growing your wealth over time, and never overpaying for stocks. That's exactly what dollar cost averaging, DCA, does for you. In today's video, we'll break down what it is, how it works, and how you can use it to build long-term wealth. Stick around till the end, because I'll also share pro tips to maximize returns and avoid common mistakes. And hey, if you love smart investing content, make sure to like this video, subscribe to Investosphere, and let me know in the comments. Are you already using dollar cost averaging, or is this new for you? Let's get started. Point 1. What is dollar cost averaging? 1. The concept of DCA. DCA is when you invest a fixed amount of money at regular intervals, weekly, monthly, or quarterly. You buy more shares when prices are low and fewer shares when prices are high. Over time, this lowers your average cost per share and removes the stress of market timing. Have you ever tried timing the market? Did it work out? Or was it stressful? Let me know in the comments. 2. Why DCA works in volatile markets. Markets go up and down, but with DCA, you automatically adjust to price changes. Instead of making emotional decisions, you stick to a plan and let time do the work. Would you rather invest regularly or wait for the perfect time to buy? Comment below. 3. The psychological advantage of DCA. Avoids fear of buying at the wrong time. Removes emotional decision-making and panic selling during market crashes. Perfect for long-term investors who want steady growth. Do you think emotions affect your investment decisions? Be honest and drop your answer below. Point 2. How does dollar cost averaging work? 1. A simple example of DCA. Let's say you invest $500 every month in an index fund. In January, the stock price is $50, so you buy 10 shares. In March, the price drops to $40, so you buy 12.5 shares. In July, the price rises to $55, so you buy 9 shares. Over time, your average cost per share is lower than if you had invested all at once. Do you think DCA is better than investing a lump sum all at once? Why or why not? 2. Real-world examples. S&P 500 and Bitcoin. If you invested in the S&P 500 using DCA, you'd have positive returns 90% of the time over a 20-year period. Even with Bitcoin's price swings, DCA investors have done better than those trying to time the market. Would you DCA into stocks, crypto, or both? Let's discuss in the comments. 3. How long should you DCA? The longer, the better. Ideally 5 to 10 years for best results. Works best in retirement accounts, 401k, Roth IRA, and long-term investments. Are you a short-term or long-term investor? Comment below and let's talk. Point 3. Pros and cons of dollar cost averaging. Advantages of DCA. Reduces market timing risk. Avoids panic buying and selling. Works great for long-term wealth building. Helps in volatile markets, stocks, crypto, mutual funds. Do these benefits make you want to try DCA? Why or why not? Disadvantages of DCA. If the market keeps rising, you might buy at a higher price. It's not great for lump sums. If you have a lot of cash, investing all at once can sometimes be better. Requires discipline and patience. You must stick to it. Do you think patience is the hardest part of investing? Let's discuss in the comments. Point 4. How to start dollar cost averaging. 1. Choose your investment. Best for index funds, S&P 500, NASDAQ, ETFs, blue chip stocks, and even crypto. 2. Set up automatic investments. Use platforms like Vanguard, Fidelity, Robinhood, or Coinbase for automatic DCA investing. 3. Stay consistent and ignore market noise. The key to DCA is consistency. Ignore news, ignore panic, just stick to your schedule. Would you set up automatic investments or manually invest each time? Why? And that's how dollar cost averaging helps you build long-term wealth without stress. If you found this video helpful, smash that like button and subscribe to Investosphere for more investing tips. And tell me in the comments, are you going to try dollar cost averaging or do you prefer another strategy? Let's discuss. Thanks for watching and I'll see you in the next video. Until then, keep investing smart